Hello, everyone. Welcome to the Debt Circle with Fixed Income webinar. This is session 3, and we are going to discuss corporate bonds in India from corporate finance to market development. And today we are delighted to have with us Mr. Ameya Abhyankar, founder of FinQuest Institute and expert consulting. With over 17 years of experience across leading institutions like IndusInd Bank, Nomura Institute, Deloitte, and Wipro, Amay is a seasoned professional in risk management, quantitative modeling, and treasury analytics. He is a CFA charter holder and holds the prestigious CQF qualification. Through FinQuest, he has been instrumental in training professionals and corporates in areas like risk, finance, and emerging technologies such as Python, AI, and machine learning. He is also a published author and visiting faculty at leading management institutions, making him a respected voice in intersection of finance, risk, and technology. Thank you so much for coming, sir. We are honored to host you.
Thanks. Thank you so much, Shifa. Hi. Good evening, everyone, and thanks for joining in. So let me share my screen. I put together a few slides for our discussion today. So we will walk through that, and then we can take questions in the end. So let me just
Sure, sir.
Start the presentation. Sure. Okay. Just let me know once my screen is visible.
So the screen is...
Okay, so all right, good.
Yeah.
Great. So
yes.
Great. So are we good to start, Shifa?
Yes, sir, we are good to go.
All right, great. Great. So welcome to this session on corporate bonds in India, and we'll discuss the idea about the market and how exactly the corporate bond market has evolved over time. How exactly does one decide between a bank loan and a corporate bond? Also, the new things or new developments which are happening in the corporate bond markets, typically pertaining to the new reforms which are coming in. We'll try to discuss them as well, and a little bit of risk management discussion, because then, as we know, for any financial quantity or other anything in life, we always do risk management, is it? So there will be some things on risk management which we'll talk about as well. So let's jump in. So understanding the trend of moving between bank loans to bonds. So now this is a question which many of you might have in mind. So do people exactly go in for a bank loan or a corporate bond? So this will be a function of a few factors. I mentioned a few below, because then traditionally these two have been very, very popular sources of funding. Of course, when you say corporate funding, then you have common equity capital, preferred stock, etc. But then at the moment, focusing only on bank loans versus bonds. So a few factors which helps companies or firms decide as to which route they would like to go. I've listed a few below. So it will be a function of the current interest rate environment, which you also called as the yield environment. I put together a few discussion points on the subsequent slide. These are just the bullets. Then, depending on the current regulatory framework or maybe the regulatory actions as well, macroeconomic factors, and that way this will help a firm decide whether they would like to go in for a bank loan route or whether they would like to go in for a corporate bond route. Now, in 2025, if you see right from the start of the year, there has been a significant shift towards the corporate bond market, which is driven by a few reasons. So let's try to understand those reasons. So one is the capex which is expected to happen in this financial year. So it's a large capex which is expected to happen, and as a reason for that, there is an increasing push on spending which will happen in key sectors, including infrastructure, digitization, manufacturing, etc. And typically, you'll observe that for these kind of sectors, there will be a requirement for long-term funds, and as a result, long-term bonds are something which are seen as a very attractive opportunity for this. Next is a drop in yields, because as we have seen recently, the yields in the bond markets have dropped considerably. So for our friends who follow the bond market, do you remember having seen what's the closing 10-year GSEC yield today? So the closing treasury yield. So I think if I remember correctly, I think it's around 6.5, if I remember correctly. I'd seen it in the morning. So that way, but you observe that overall the yields are very, very opportune, and that is something which makes it very advantageous for companies to raise capital as compared to equity. Because then, as we know, we have the idea of the weighted average cost of capital, isn't it? And every company wants to optimize the WACC number. And if you, I know, I mean, in the long term, every company is going to have a certain target capital structure in mind, whereby they say, okay, we want 50% equity, 50% debt. But then in the short run, there can be certain movements which can happen between either side. So that way, if the company is looking for funding, and if the current bond market is really good, then I think they wouldn't mind for a short-term shift away from this long-term capital target ratio. So that way, the drop in yields is something which is driving companies to raise bond funds. And also, we observe that the policy rate, which we also call as the repo rate, we observe that the regulator has gone in for significant cuts from the start of the year. And as we know, this is a rate which gets determined as a part of the MPC, or the Monetary Committee meeting, which happens after every 2 months. So basically 6 meetings every year. And at the moment, the policy repo rate stands at 5.5%. So that's another driver from the macro perspective. Now, investor interest. Now, the first box, if I talk about, so it's inclusion of Indian government securities in the JP Morgan GBM, or what we call the emerging market index. So this inclusion had happened about a couple of years back, and this was a significant development for the Indian market, because then this helped in significant interest from foreign investors. And so any thoughts as to how this is considered as advantageous from Indian market or Indian bond market perspective? So would anyone like to comment on the first box? So feel free to answer. So you can make a guess. You can either unmute, or maybe you can put it in the chat as well. Yes, Jay, please go ahead.
You can also write them in the chats. We can see it there as well. If you aren't able to switch on your mic, that's fine.
Yeah, that works too. So either ways. Great. So we will wait for Jay's response. But in the meantime, I mean, you'll observe that and there's an increasing interest from global investors. And as a reason, you'll observe that certain derivative products are also getting a lot of traction. So some of you might have heard of a popular derivative product called as a total return swap, or many times we call it by the acronym TRS. And you'll see that after inclusion of there is something in the chat, and we'll come to the TRS point. So let's see what's the answer. It puts correct. Yes, yeah. Thanks, Jay. Yes, absolutely. So as Jay rightly pointed out, it is definitely considered as a recognized investment option, and especially if you look at certain portfolio managers who follow, maybe for simple example, let's say they follow a certain passive investment strategy. So if they follow passive investments, naturally they will have to mirror the index which they're tracking, and as a result, if Indian government security is included as a part of a broader index, and if they happen to track that index, they are going to have that security as a part of their portfolio as well. So that way, it gets included as a part of global portfolio managers' funds. And the next thing is even so you can either invest directly, or maybe if foreign investors want to have exposure to the Indian GSEC market, they can do it through TRS as well, as I mentioned, total return swaps. So just to give you an idea, TRS is a product where it's just like a swap, whereby you're going to exchange cash flows at specific points in time. So one of the parties, so let's say a foreign investor, they are going to expect a return on the government security, whereas as a cash flow from their side, they are going to pay either a certain fixed rate or a floating rate of interest. And they can agree to what frequency at which they will exchange these cash flows with the counterparty. So that we will observe that many foreign investors, even if they don't have if they don't complete the entire formalities to actually formally participate in purchase of GSEC, they can still do so through the TRS because in the end, it's replication of cash flows. So, and if they're able to do it through the total return swap, excellent. So that's another product which got a lot of fillip after inclusion of the GSEC in the JPM index. Uh, is it secured? Yeah, so Dharmendra, when you say is it secured, do you mean the investments in a government security? Is it? Okay, so we will wait for Dharmendra's response. So moving on, I think it's in the Q&A. Yes, so Dharmendra, the way in which we look at the GSEC market is it is so when we look at treasury securities, they are backed by the full faith of the central government. So RBI issues them on behalf of the government of India, and they are considered almost as risk-free. So we don't expect them to default. So yes, they are considered as secure. Uh, Also, and there is a so if you see from the foreign investments point of view, because we have a better liquidity and better price discovery because of increasing participation from global investors, the investments from foreign investments are also increasing considerably. Role of institutional investors also is an important factor which plays a role in the growth of the market. So that way, when we say institutional investors, typically you'll have mutual funds or insurance companies or pension funds, etc, and they trade a lot in corporate debt or even in the treasury securities as well, because then typically some of them might be looking at something like a maturity matching or maybe duration matching kind of a strategy, and they're trying to manage their portfolios accordingly. So as a result, there is an increasing interest from institutional investors also. And the other important component is participation from retail investors like you and me. So as retail participation increases, that means households are also willing to invest their money in the fixed income market, which plays a big role because institutional investors anyways are active when it comes to bonds, but typically retail participation was lower earlier. But then there are certain reforms which have come up of late. We'll talk about one of them on the next slide as well. And as a result, there is increasing participation from household income. So that way, household savings are getting invested partly in the bond market, which again supports in the overall growth and liquidity of the bond market as well. Talking of regulatory reforms, so that way, some of you might have come across a centralized portal whereby the bond listing happens. So this was SEBI's initiative, and this platform provides a ease of access to information to investors. I think that's a big plus because then otherwise, without a single place portal, one would have to go and search for individual bond issuances and then go through the individual bond prospectus and get further information. But then it's very, very convenient if we have everything listed on one single platform. And that way, this is something which helps investors gather the required information and take a certain informed decision as well. Also, the listing process, which goes in for public bonds, because then, as we know, corporate securities typically go in for a private placement or for a public issuance. So, if it's a public issuance, there's a standard process which is to be followed. But then SEBI has streamlined that process considerably, which helps in further reduction of any kind of operational burden on companies, and that streamline things considerably. And is there something in the chat? No. Okay, there was some sound in the background. And from a retail investor's point of view, so if you see this point on reduced ticket size, so the Reserve Bank of India has minimized the minimum ticket size required for a retail investor to invest in a corporate bond. Earlier, it was set at 1 lakh. Now it is 10,000 rupees, making it a lot affordable for households to invest in corporate debt as well. Also, there are popular online trading platforms which have been opened up. One good example is Altifi, which is so I think it's altifi.ai. So later on, you can check out that website as well. So it provides like one single platform which allows us to conduct trades and using something called as a RFQ platform. So RFQ platform was initially designed for institutional investors, but a few months back, it also got accessible to retail investors as well. Again, giving a further fillip to the trading of corporate debt. Better to be a bit slow. Okay. So I can slow down a bit. Yes. Now, understanding a few advantages of bonds over bank loans. Again, now there are different points in time whereby you might want to choose one over the other, but then focusing on the advantages for the moment of bonds over loans. So one is faster execution. Again, this can be arguable because then someone might say, okay, I mean, a bank is quickly approving a loan much faster than issuance of a bond. Absolutely, it can happen. But then this is just one example. So bond issuance may happen quicker as compared to a bank loan approval. So that way, if a company is going in for raising capital, they can do it through a bond issuance. It is a diversified source of funding because then rather than depending entirely on bank lending, they might want to ensure access to capital, especially whenever the lending environment is a little tight. Long-term funding, typically bonds are ideal instruments when it comes to long-term funding of capital projects, I would say, typically infrastructure or any kind of other capital budgeting assignment. It increases the investor base as well. That way, we'll have as there's more and more participation which comes in, it helps in better liquidity and better price discovery. And advantages from a tax perspective as well. So, as all of us might remember, the formula for WACC, isn't it? And in the WACC formula, if you see, there's a tax shield component which comes in. So, interest payments provide the tax shield. So as a result, if we go in for a bond funding, it also helps companies optimize the WACC number. And all of us know the importance of WACC. It's like a good representative to start when it comes to any kind of analysis, like, let's say, company valuation or business valuation or capital budgeting and so on. So it's a good reference number to begin. Also, a flexible structure, because then corporate bonds can be designed in different forms. So agreed that most of them will be plain vanilla, but then there are different kind of structures which can be offered as a part of a corporate bond scheme. So it could be a step-up bond, or it could be a floating rate note, etc. So one good example of a step-up bond can be thought of as something like a bond which is linked to green bonds or ESG. So maybe we'll talk a little bit on step-up bonds when we talk of ESG. I have a couple of slides which talks about the reforms from the ESG framework point of view. So maybe we'll talk about the step-ups at that point in time. So does this speed is this speed okay with for everyone? So I think there was a point saying that I need to go a little slower. So does this work? Okay. Okay. All right. Yeah. Yeah. Thanks, Jay. Also, understanding the market demand for quality issuances. Now, naturally, as you may expect, the demand for investment grade debt is generally high because typically, if you look at banks or even certain investment funds, they will be looking at investment grade debt only, typically between triple A to triple B. So that's why the demand for them is always high, and that's very common because most of the times banks uh, will have a certain bank risk policy which will say that they can invest only in investment grade debt. Similarly, many asset managers, especially if I talk from a PMS side of things, they might have a certain mandate which says, as a part of their investment policy statement, that they need to go in only for investment grade bonds. So that's why the demand for these is always high. And that way, there is an increasing requirement of capital from infrastructure, utilities, conglomerates, etc. And typically, these are thought of as a lower risk investment and also something which supports long-term funding requirements. Sure, there is other extreme as well, which we talk from a high yield bonds perspective. So when we say high yield bonds, these bonds are on a lower rating scale as compared to investment grade. So there could be certain market investors who are interested in these kind of risky instruments because then there's a potential to earn a higher yield on non-investment grade debt. So this can be an attractive option for certain investors who have a higher risk appetite. And for a short term, we know that companies issue commercial paper because then commercial paper is something which is used for meeting the working capital requirements of companies. And generally, CPs are for a tenor of 1 year. And at the end of 1 year, companies are going to keep on rolling over those CPs to meet all of their working capital requirements. Again, forming a part of the broader corporate bond market. So again, CPs is something which helps increase the investor participation. Now, talking a little bit on the ESG framework. Now, why I thought of bringing in this slide, because ESG is something whereby there is a lot of work which is happening on a global scale. So I would say about 2-3 years back, the work began on ESG, and that way there is. So although not too much of monitoring work is happening on ESG as yet, but I think going ahead it is only going to increase. So that way, especially our friends who are looking to move into bond trading or maybe bond investments, etc. Reading up a few things on ESG, which we call as environmental, social, and corporate governance initiatives. That framework is something which you can definitely look up because it is relatively new and it's always good to know. So in case you develop interest in that, that can be like a good area to pursue. So talking a little bit from ESG debt, or typically what we call as green bonds. Now, globally, definitely there is a lot of work happening. And also, if you see that there are global many regulations which are there around ESG as well. So many of you might have heard of terms like Sustainability Development Goals, or SDG goals, as we call it, whereby every country is committing that, okay, by such and such a year, we would like to reduce our carbon emissions or our carbon footprint by a certain quantum. And that way, that's a target which they're setting for themselves. And as a result, there is an increasing demand for ESG-like investments. So to be in sync with that demand, SEBI in the month of June this year has come up with the ESG bond framework, which gives like a formal structure for such kind of green bonds. Now, different types of instruments which are covered under this particular framework, because then if you see there are many other varieties which you can observe globally, but this framework typically talks about 2-3 varieties as I mentioned here. One is social bonds. So these could be for funding initiatives like affordable education or maybe healthcare, or even I would say for funding education for underprivileged kids, etc. So these are all of social causes which are funded through social bonds. Then we have sustainability bonds. So when we say sustainability bonds, these can be thought of as something which will have a long-term impact on our overall environment. And so things like climate risk, etc., everything gets covered as a part of this. So many times, sustainability bonds can be thought of as a combination whereby it will take into consideration environmental factors as well as social objectives as well. So popular examples can be clean energy or green energy projects. There are sustainability linked bonds. So this is where I'd like to introduce the idea of a coupon step up or a coupon step down bond, for example. So, just to give you an example, so let's say a company issues a sustainability linked bond and they call it as a green bond. And let's say the bond has a tenor of 5 years, and let's say it has a coupon frequency of 6 months. And let's say the starting coupon is 3%. I'm just making up a number for our discussion. So then the bond prospectus will say that the company is going to try and reduce its carbon footprint over time. And if the company is able to do so, then on every subsequent coupon payment date, the coupon is going to go in for a step down. Whereas if the company is unable to meet its carbon footprint requirements, that way, if it's unable to reduce the carbon footprint, that will push the coupon up. So let's say I start with 3%. If the company does well on the carbon footprint side, that 3 can come down to, let's say, 2.75, then maybe a 2.5, and so on. Whereas on the other end, if the company is unable to meet its carbon footprint, it can start with 3, it could go to 3.25, 3.5, and so on. So that way, these are also popular examples of what we call as coupon step up or coupon step down varieties. And there's just one example of a sustainability linked bond. Now, of understanding a few provisions under this, because then I would definitely urge you all to go through this new framework, because then it will give you further idea into how it's expected to be consumed by the Indian market. But just covering the main provisions here. So, firstly, there is the requirement is there should be a clear definition and alignment with global standards. So that way, why exactly a certain bond is being issued, that has to be very clearly mentioned. So that way, people should know where that money is going to go, and that should be clearly specified in the prospectus. Also, the issuer have to demonstrate their alignment with globally accepted frameworks, including climate bond standards, ICMA principles, ASEAN standards, or even European standards, etc. There is a validation which is required as well, which would call it as maybe a mandatory third-party review. So think of this as an independent review, and independent reviewers are going to do a thorough check so as to understand whether the bond which is being issued, it's actually supporting the ESG initiatives, and also they will review the disclosures and also verify the impact data both before and after issuance. So think of this in line with the idea of model validation. So I know a few of our friends here could be working as a part of model validation practice. So maybe in addition to maybe treasury or stress testing or risk models which could be validating, probably this could be one more initiative which can come up at a later point in time, whereby you would be validating or acting as a third-party reviewer or auditor for a certain company issuing such bonds. Also, the framework specifically mentioned that there should be a proper labeling of the bonds as well, which should be in alignment with the global norms. Uh, that way, the main idea behind this is to ensure integrity of such bonds, and they should comply with the global norm on ESG investments. Uh, Also, only the eligible project should be funded through that. So there should be a careful analysis which should be done as to where this green bonds money is going to get invested. And also there should be companies or issuers should refrain from any kind of misleading labels or claims. Because then there could be certain investors who might get misled into what the investment is. So it should be very, very clear cut, and the labeling should be very, very crisp. And also enhanced disclosure requirements. So that way, the number of disclosures required, especially for these new initiatives like green bonds, are tremendous. So there are certain disclosures which are required before the issuance, and something which is required after the issuance. So before the issuance is also what we call as a pre-issuance idea. So that way, this will include definite project goals and what kind of ESG objectives are being targeted. Also, if you're looking at social impact bonds, then the target population should be clearly identified. So let's say if you're looking at supporting education for underprivileged kids, then that way the target population should be maybe kids who are school going, and the entire fund should be invested for their benefits. Also, there should be a mechanism for tracking the outcomes, because then, as we know, for even in risk management as well, isn't it? We require a very, very strong tool which will help us track what is the overall result, isn't it? So think of it like a MIS report which you generate. So this is also very, very similar. So that way there should be mechanisms to track the outcomes and to understand whether they are in line with the ESG initiatives. And once the bonds have been issued, it's more like a continual monitoring which will happen as well, which we call as the post-listing disclosures. So that way there should be periodical reports giving how the funds are being utilized. Also, metrics capturing the social and environmental impact. So how exactly is it benefiting the society? So maybe affordable housing, giving maybe the volume or maybe the number of units of housing which have been developed, or probably the number of primary schools which have been opened. Or it could be environmental, saying that, okay, I mean, we have been able to reduce the climate risk through things like carbon emissions, etc. So that should be, so some metric should be there to track it. And validation of outcomes by third-party reviewers. So again, this is where model validation guys can find prospective work as well, because then there will be an independent review of things. And that way, the guideline also talks about things whereby in case there is a certain deviation which happens from the predefined goals from the ESG perspective, then also companies need to define what is the corrective action plan which they have in mind. And also, if they're unable to meet such kind of ESG guidelines and they start falling short, then there should be a mechanism for early redemption as well. So these are just a few important provisions which have gone into the ESG bond framework, which has recently come up. Just a brief on ESG bond market in India. So compared to the global arena, the ESG bond market in India is still in a nascent stage. But however, there is increasing interest both from government as well as private institutions when it comes to issuances of ESG bonds. So that way, RBI has started issuing government sovereign green bonds. and a significant amount has been raised over the financial year 2025. From a corporate perspective, one notable one was a green bond which was issued by L&T, and it was a sizable money. So I mean, INR 500 crores is a big amount of money, but then that was a very prominent one. And hopefully, going ahead, more and more companies will participate in such kind of issuances. Possibly, as the number of issuances increase, there could be increased demand from institutional investors, like, for example, mutual funds, because then mutual funds might have a certain thematic fund which will look specifically at clean energy, green energy, or ESG in general. And that way, as the number of issuances on green bonds go on increasing, it's expected that there will be increased participation from institutional investors, which will only help increase the overall volume and a better price discovery as well. So something in the chat. No, so municipal bonds will be a little different than ESG bonds, because municipal bonds don't really have or may not have a specific environmental, social, or corporate governance idea in mind. Because then, as we know, for every bond, there is a certain end goal which needs to be defined clearly as a part of the prospectus. Whereas for municipal bonds, it could be pertaining to certain spending in a certain municipal jurisdiction. But then ESG bonds will be a little different. They would be there to support either one or many of these, either environmental, social, or a CG perspective. So that way they are a little different as compared to municipal bonds. Now, talking from which sectors which could particularly be well suited to tap in the ESG bond market, there could be many as well, but here I have listed a few which are the most common. One is infrastructure and urban development. So that way, especially clean energy or green energy projects which come up, that is something whereby, I mean, they will find a lot of takers, because then you'll observe that many times even real estate which is getting developed, let's say even housing market, you'll observe that there's a lot of marketing which in the marketing material, developers will specifically say that it's like an environmentally friendly thing. So there will be certain guidelines which they must be following as well. And infra projects, definitely there's a lot of push on clean energy and green energy, because then the thing is, we have begun to realize that climate risk is real and it is impacting us in a variety of ways. One very common metric is rising sea levels or even melting of ice in the Arctic region. So those things are getting real, and people around the world and even administrations globally, they have begun to notice these problems, and as a result, there's an increasing push on the ESG projects. Then renewable energy and clean tech, so what we call as green projects. BFSI could find a lot of application to the ESG market. So typically, whenever they're helping companies raise bond funds, for example. Social infrastructure, so that way affordable housing is a great example for this. And also, large listed companies will start tapping more and more into the ESG market, because then, as we know, about a couple of years back, SEBI had issued a guideline which said that the first 1,000 listed companies are expected to do disclosures from the ESG side of things. So gradually that is going to increase. So that's why you'll observe that many companies have their own sustainability teams which they have set up within their own firms, and they're working very closely from this ESG side of things. Now, talking a little bit on the risk which you observe in the bond market, because then risk is prevalent everywhere, and there's a requirement that there should be some kind of risk mitigants as well. So here we'll not discuss any specific risk mitigants as such, but we'll primarily talk of the main risk which a corporate bond market in general is exposed to. So one is liquidity. So when you say liquidity, think of this from maybe a price and a funding risk both ways. So maybe thinking more simply, simplifying from a price risk point of view, it's a slightly easier one to understand. So when I say from a price risk perspective, that means, let's say if you're having a government security and let's say a corporate bond on your portfolio. So let's say you just have two bonds on your book. Then you would find a ready market for GSEC. So that way, treasury securities are very liquid. And typically, if you are pursuing specifically on the run issuances, GSEC is very liquid. But then a corporate bond may or may not give you that kind of a liquidity, because then not every corporate bond gives you that kind of a liquidity benefit. So you may not be able to trade it very, very quickly. Of course, now those bonds which are issued by highly rated companies and specific issues, and they are very liquid and you can trade them, but that may not be applicable for all of them. And you can get to see the volume information on bonds on a variety of websites. So maybe you can check it on Bloomberg, or maybe you could look it on FBI or FIMDA's website as well. And you will get an idea of the kind of bonds which are traded on a certain day. So that gives an idea of what is the liquidity which you see for a certain corporate bond issue. Default risk, definitely real, because then for a treasury security, default risk is assumed to be zero, because then the government is going to step in case there are any problems. But then for a company, this risk is real, because there is a chance that if their business does not perform as per the requirement, they may not be able to meet the coupon payment or even the final principal payment requirements on the bonds. And as a result, investors will be exposed to a potential default risk. Now, generally for investment grade debt, this is not much of a problem, because then these are highly rated companies. But for below investment grade, this can be a problem, and then risk managers might want to take certain additional corrective actions in order, or maybe have certain mitigants in place. Optionality risk. So when you say optionality risk, think of a bond which is like a combination of a fixed income stream plus an option on top of it. So think of it as a combination. You have a cash market product, which is bond, plus a derivative, which is an option. And there can be certain optionalities like an issuer call option or an investor put option, or maybe both as well. And many times it happens that because of this optionality, it can actually disturb or potentially derail the cash flow receipts. Because then maybe someone might have purchased a bond with the hope that, okay, I mean, the bond is going to pay certain cash flow at specific points in time. So let's say I purchase a bond which has a tenor of 5 years, and every 6 months it is going to make a repayment of certain interest rate on the coupon. And imagine there is a issuer call option. So it can so happen that I have some other liability which I have earmarked for this. So that way, every 6 months when I receive an interest payment, that payment will be transferred in order to satisfy the liability. But then let's say the yield environment changes and the issuer decides to make a callback of the bond, and then I get the full redemption earlier on. Then that can derail my plans to match my cash flow dates at future points in time. Uh, so that's what we call typically as an example of an optionality risk. Inflation risk as well, because then bonds will be at a fixed rate bond. It will be exposed to inflation, because then inflation, which we can measure through the number CPI, which you call either CPI or WPI, but CPI is more popular. Yeah, sorry guys, I think my Wi-Fi just dropped. So let me just reshare. Yeah, so I think I lost you on the demand shift one. So and we're almost there to the end now. So when I say demand shift, that means there'll be a shift between a corporate bond and a bank loan, depending on the current yield environment. That shift can happen, and again, that can have an impact on the kind of volume which you're seeing in the corporate debt market. So again, these are a few common risks. There can be a few more as well, but these are the ones which you see very, very frequently. Yeah, so I think that's about it. So that way, if you see, we have covered the fundamentals. So we covered how exactly the corporate bond market is shaping up currently. So we are looking at contemporary time. So that's why I took the data from 2025. We saw what were the reasons as to why people are now shifting, or maybe companies are shifting to the corporate bond market.
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks including delay and or default in payment. Read all the offer-related documents carefully.